Hey, what's up everybody? My name is Abel Perez and I'm a loan officer with American Pacific Mortgage. And if you are watching this video, I'm glad you found it because unfortunately the original event link broke on me and I had to create a new live event. But anyway, we're gonna go ahead and get started. Now, although this is a live event, these live events are really built for that face-to-face, person-to-person interaction that allows you, the viewer, to comment real time and provide some feedback and allow me at the end to provide that question in Q&A immediately. So this is the first video that I'm doing, so I am not expecting a huge live following. However, this video will be posted and saved to YouTube for further viewing. So we're talking about own a home, own your vision. And everything pertaining to this video is surrounded by the concept of the cash out refinance. So if you are a current homeowner, you are eligible to explore options with either refinancing your current home loan and of course receiving a cash out refinance. So what does that mean? We're going to talk about all of that cool stuff. You're going to, by the end of this, you're going to know what a cash out refinance is, how to determine how much money is available to you, and I'll give my own personal testimony on how the cash out refinance has helped me personally. So my relevance to the cash out refinance, as I stated, professionally, I'm a licensed mortgage loan officer. And so knowing the loan programs, the requirements, and the process is something that, that I'm required to know because I'm performing it on a day-to-day basis with my current clientele. And so I get to see many different situations, many different scenarios, and you know, it's not for everybody, but it certainly helps a lot of those who do qualify and who do take advantage of it. So it's a really good program, which is what excites me about it. So professionally, that's what excites me about it. But of course, what are my personal experiences with the cash out refi? I do have personal experiences. In fact, in 2015, we did a cash out refi. We didn't take out all of the equity. And by the way, equity, loan to value, those are all definitions that I'm going to actually explain to you. So bear with me. But my relevance is in 2015, we did our own cash out refi. And we wanted about $30,000, you know, to $30,000 cash. Now, this is a loan program, so you do have items like closing costs. There are some costs associated with the cash out refi, but ultimately we had $25,000 in cash given, you know, available to us, and we were able to do so much with it. And we literally had a checklist of things that, you know, we were going to do with this money. And so you can see here, and again, this screen right here, not sure how clear you can actually see it. I wanted to put these notes so you can follow along, but like anything, the more we do it, the better we'll get, right? So bear with me on this first one. Paid off student loans. We had about $7,000 in student loans. We were able to pay that off. Paid off medical debt, about $4,000 there. Purchased orthodontist plan. As you know, I wear braces. That was about $6,000. We were able to pay that plan off immediately. Eliminate credit card debt. We had about $3,000 there. And then we funded a startup company, which the remaining amount was used, about $5,000. So $25,000 made available to us within 10 business days. And we were able to really consolidate a lot of that debt and utilize the equity that we have established over our home over 6 years to do some of these things that we were really priority to us. And when we had initially purchased our loan, we had a higher interest rate. I think we were like at a 5.5%. When we refinanced, we were actually at a 4.5%. So we actually got best of both worlds. And we'll talk about both of those worlds here coming up. But we actually got best of both. So for an extra $22 a month added to our mortgage, we were able to do all of this and do it all instantly. And again, we didn't pull out all of the equity in there, so we still had plenty of equity to make decisions later on down the road, which has been very helpful. So that's part of owning a home, owning your vision. We had a vision, and we literally chipped off every single category or checked off every single category when it comes to the opportunities or the availability to do different things with that cash. So let's get into it. Congratulations, you are watching this show because you either Googled or YouTube, how do I get money or cash out refinance? what's that all about? How can I utilize my equity, take advantage of the rising housing market and without having to move, right? So knowledge is power. So congratulations, you found this video. Now, of course, this video is only going to give you a blimp of what a cash out refinance it truly is. Quick disclaimer, I'm not a financial advisor. I'm not a CPA. I know that there's plenty of other opportunities or versions of financial loan programs out there available to you. I'm not saying this is the best one. I'm simply giving those who are current homeowners and would like to explore a cash out refinance, I'm giving those individuals the information needed. But again, at the end of this, I'll give you my contact information. My contact information's in my info in the settings. You can contact me directly. I love to have phone conversations. I love to have face-to-face conversations even more. So let's meet up and see how we can tailor your specific situation to benefit you and execute your vision, okay? So knowledge is certainly power. And today, I'm gonna talk about some important terms and components of the cash out refi. So first, I'm gonna give a little bit about the traditional refi because it's always good to compare and contrast. And then we're gonna, of course, talk about the actual cash out refinance. Some of the definitions that are gonna be key for you to know because you're gonna hear them either your loan officer, or if you're talking with me, or your real estate agent, or your friends or family, you're going to hear that term loan to value. And it's such an important component when determining how much money is available to you that we're going to discuss that. Equity goes hand in hand with that. It's referring to the same exact thing as loan to value, but it's giving you a different version or a different way of giving you that number. So we'll discuss that. And of course, your appraised value of your home. We'll get into those final details. So this is kind of the outline that we're going to be reviewing. So let's get right into it. A traditional refinance. So traditionally, when you think about refinancing your home, which many people do take advantage of, the real purpose of refinancing your home isn't to get money back. It's to save money, right? And so the purpose would be to lower monthly payments, and you can do that by taking advantage of lower interest rates during that time, if available. Remove mortgage insurance if that applies to your current loan program, or improve loan terms or programs. Sometimes individuals, they want to, they've been paying 5, 10, 15 years on their home. They want to lower that monthly payment, so they go and refinance into another 30-year loan, spread that current principal over 30 years, which will lower that payment for you. Or, again, they might want to lower the terms as well. So there's plenty of programs out there available, and that's really what it helps you to achieve. And then, of course, payments are based on the new lower principal. So kind of like we talked about, you take that lower principal and then you spread it over another 30 years instead of the 25, 22, whatever it may be for your unique situation. So traditional refinance, you're looking to lower that monthly payment. I want to save some money. I want to get into a better loan program. Maybe you got stuck with a interest-only loan program, or an ARM rate where on an annual basis your interest rate is fluctuating and you want a little bit more stability, you want a fixed rate, and so a traditional finance is going to be just for you. So if you have more information or you are seeking more information on a traditional refinance and seeing what options are available and how it can impact your monthly payment or your loan program, please contact me. Information is located below. But again, we're talking about the cash out refinance because we want to put money in your hands, right? We want to give you the money to do all the cool things that I did in 2015, right? And that was cool to me. Of course, your situation is going to be unique, and the amount available to you is also going to be unique. So you could achieve way more than I earned, and a good loan officer is going to be able to walk you through those different figures and really make it to where it's not only comfortable, but it makes sense to you, and it's ultimately your decision. So when we're talking about the cash out refinance, what's the purpose? It's to obtain cash, bottom line, right? We want cash in our hands, and we want it because we have a vision for something, whether that be goals or whatever the case may be, consolidate debt, right? So what are the deciding factors when determining, okay, how much cash is actually available to you, right? So we talk, your appraised value is going to be, it's going to determine how much your home is worth. And we'll talk about appraisals and how that's determined, but just keep in mind your appraised value, and then of course your loan to value or your equity is going to be that deciding factor. So loan to value and equity is important. So let's get into, we got appraised values next. So we're going to talk about the appraised values because we want to know how much your home is worth, right? So the appraised value determines the value of your home based on the sale of comparable homes in your area. So a lot of cool tools out there these days, right? Zillow.com, Realtor.com, and they do a pretty decent job of giving you an idea of what your home's estimated at. Now I do want you to be aware that those aren't the most accurate figures, but they are going to give you a pretty decent ballpark figure. Now, if you bought your home between 2009 and 2013, you're going to be pretty stoked because the market has risen significantly, and during that time, prices were nearly at an all-time low. And so that's a perfect storm for having a lot of equity or high LTV for your current loan. So you may be able to see that you may have bought your home for only $200,000, and Realtor.com or Zillow.com is stating that your home's estimated about $250,000 to $260,000. Now that should excite you, and I'll explain why in just a minute. So that's how the appraisal. Okay, so real quick with the appraisers, the appraisals. When I say they're comparing homes that are actually sold around you, so you're going to take what the appraiser is going to do is they're going to go in and inspect the home. They're going to determine, what amenities, what features, what upgrades, what has been done, right? And then they are going to go look at recent sales around your neighborhood, and they're going to take items like that, and they're going to say, okay, we're going to put a $10,000 value on granite countertops because this one sold and it had granite countertops. Now we're gonna, this one here is being appraised. It doesn't have granite countertops, so we're gonna subtract 10,000 from that value. So what they're doing is they're taking these homes and they're comparing them, so they're comparing apples to apples. They're trying to get the closest determination on what the average consumer is actually willing to pay for and how much. And the best way to do that is look at current sales that are out there. So that's a little bit about appraisals. If you have more questions about appraisals, please reach out to me, and we will have that conversation directly. So LTV and equity, loan to value and your equity, I put them in the same on the same slide because they're so relevant to each other. When we talk about loan to value is the percentage of what you owe versus the value of your home, right? So it's the equation for that is loan divided by appraised value, and that's going to give you your LTV. So going back to that same scenario I told you earlier, if you currently owe $200,000 of principal on your home loan, and your appraised value is $250,000, you now have 80% loan to value. So 80% loan to value, and those numbers are very relevant. That 80% especially, and that's why I set up that number that way. It's very relevant because if you set yourself up with an FHA loan or other government type loan that required you to have mortgage insurance, and mortgage insurance is that pesky extra $150 up to $250 that you're paying on a monthly basis just because you didn't come in with 20% to start, right? So if your LTV, if you do that equation, your loan to value is now 80%, guess what? You now qualify to get that mortgage insurance removed. And so you're gonna have that immediate savings off of that. And then of course, interest rate is also factored in for that time frame. But that's why LTV is so important. I went out of my way to explain that to you because loan to value, that percentage right there is crucial when determining whether or not you're stuck with that mortgage insurance premium. So on the other side, we have equity. So again, loan to value is going to give you your percentage. And then equity is just the difference between what you owe and what the appraised value of your home is, right? So it's an actual dollar amount, and that's your equity. So loan minus appraised value is going to give you your equity. So in the example, same situation as before, we're going to take $250,000 because that's what your appraised value is, and we're going to subtract that by $200,000 because that's what you owe, and so thus giving you a $50,000 equity result, right? So you have $50,000 in equity now. Based off that situation, if that situation is true to you, right? So again, the equations are here. You can work that out yourself, but loan officers are so underutilized. give me a call. I can help you walk through that process step by step and give you those exact figures for you. And then of course, it's always nice to have an individual who's going to give you information surrounding those initial questions. So that'd be me. Moving on over to the so when we talk about loan to value, the LTV, why is 80%? 80% is kind of like a magic number, right? At 80%, you're no longer having to do, you're no longer having to have mortgage insurance. But 80% is used typically the standard guideline of how much of your equity that you're actually allowed to borrow. So 80% is a huge number. So when you think about, if you're ever stuck on those numbers, think 80, okay? 80 removes mortgage insurance. 80 is the amount, 80% is the amount of percentage that you can obtain from that equity that you've established. And the reason why 80 is so important is because the bank or the lender is wanting to have that 20% cushion. They want to know that if you were to default on your home loan and they were to take over that house, that they would have a little bit of equity built in so they can take a loss on it, sell it, and recoup those funds. So 80% of that cash. And what does that look like? So if you have $50,000, of equity, you would take 50,000, multiply it by 80%. It should give you around $40,000. So if you have $50,000 in equity, they're not going to let you borrow all $50,000 and give you a loan to value of 0%, right? They're going to want you to go, or give you an equity amount of $0. They're going to want to give you 40% or 80% of that, give you 40,000, and you still have $10,000 in equity just to fall back on. So it's actually a pretty cool cushion. It works out in the end to really protect not only the borrower but the lender as well. And it helps stabilize the housing market by eliminating negatives. One thing you got to understand about this cash out refi is it's still a loan. A lot of people, they tend to think, oh, well, this is my money, and true to an extent, it is your money because they literally hand you over money. It's not like a car loan. It's not like a business loan where they monitor where you spend this cash that they give you. This cash is available for you to do whatever you want. You saw I was all over the spectrum on where I spent that money, and that's what makes it pretty nice and really flexible. And for me, in my situation that I gave, it was almost the perfect scenario where my payment only went up slightly, $22. I had $25,000. I was able to consolidate all my debt and of course make some advancements both personally and professionally as well. So it's still a loan. That money that you're getting, I want you to understand, you're still assuming that into your loan. So go back to the $200,000 that you currently own. If you're going to take 80% of your equity, you have 50% of that equity, that's $40,000. So now you're at $240,000. Your new loan amount is going to be $240,000. You're still paying that out. And if you choose a 30-year fixed rate, that's still going to be taken out of, you're still going to ultimately be paying that $240,000 in principal. And then of course you factor in the interest. And so that's why that's why I did disclaim early on, I'm not a financial advisor. I'm not saying that this is the best long-term solution, because you do have to pay that interest over a 30-year course, which is going to possibly or potentially cost you a lot more money than some of these other loan programs in the long run, right? But it makes this money available to you instantly. It gives you the availability to spread it out over 30 years, so the monthly cost isn't going to be outrageous. It's going to be really reasonable. And when you consider interest rates on a lot of personal loans or lines of credit, those could be double-digit interest rates, right? Whereas a home loan is generally, just depending on the market, depending on your credit score, a lot of qualifying factors, right? But you're generally looking at, let's say 5%, even if it's 5%, that's half of the interest rate that a lot of these personal loans start off at. So again, I kind of went over that a little bit, but qualifying factors do apply still. So it would be like you're applying for a regular fresh home loan, because that's exactly what it is. It is a home loan. So your credit is still going to be taken into consideration. And minimum credit for an FHA loan is 580. For a conventional loan, it's 620. And so that's all to be taken into consideration when you are when you're actually considering qualifying for this. Also, your employment is being taken into consideration. They want to ensure that you have residual income. Now, a lot of people say, man, I already have this loan. I'm already approved for this. Why do I have to reapprove for it, right? Well, you are assuming more. You are assuming more debt when you do a cash out refi, potentially, right? It's case by case, but most of the time you are assuming more debt. And it's an opportunity for the bank to reassess your situation and determine if you are financially sound in terms of having that residual income coming from your employer. So 2 years work history is going to be required, and then of course it also depends on your full-time or part-time status. And then of course assets in this situation, your assets is going to be your equity. So they're going to determine, all right, is there actual equity in the home? If you don't have equity in your home, then unfortunately a cash out refinance isn't going to be something that that is going to be easily available to you, nearly impossible. And so assets in this situation, a little bit different than actually applying for a loan for the first time. In this situation, those assets are really going to the closing costs, because again, it is a loan. There's processing, there's underwriting, there's title. Everything goes into filing this type of loan. So you're looking at costs for that. So if you are curious to see where you stand, and it's something, maybe there's a business that you've been wanting to start. It requires $5, $10, $15, $20, even $50,000, or whatever the case may be, and you want to see what type of money is available to you, give me a call. My name is Abel Perez. I'm a loan officer, and I'm located here in Madera, California, licensed in the entire state of California. I am mobile. I do have clientele up and down the state, and so there's no restriction on where I can go within the California limits. So please reach out to me if you have questions. Let's figure out where you stand, and I'll let you determine where that money goes. But my job is to get you qualified, get you into the best loan program, and provide you with the best information possible. Which is why I make this video, because I know it's hard to just pick up the phone, schedule a meeting, get with somebody, and I feel like I can touch a lot more people through these videos. At the leisure of, right before you go to bed, while you're laying in bed, you're watching YouTube videos, you can watch this, obtain that information. And so it's not just for you, it's for all your friends and family. So please share this video, like this video, comment on it, leave comments. And if you're not watching live, that's okay. Leave comments, I will respond. I get alerts sent directly to me, so that's not an issue. I will answer your questions. You can always text message me. My information's in my profile. Shoot me an email. Let's exchange information, contact information, and we'll answer all of these questions for you. So if you have any questions, so generally at the end of these live videos, I'll open it up for Q&A, and it'll allow me to answer questions. I'm not expecting a lot of live viewers, because the original link that I had set up online was broken and I wasn't able to access it. But my name is Abel Perez. Here's some of my contact information here. I hope you enjoyed this video. I hope it helped answer a little bit of question. If anything, it was meant to really spark some additional curiosity for you and really give you some a basic foundation. So when you do give me a call and we start jumping into the qualifying factors and discussing loan to value, appraisal, and equity, you already have that foundation, and you know what I'm talking about, right? So again, my name's Abel Perez. I'm your favorite loan officer. Please comment, share, follow us, and I look forward to providing more information in the future and continuing this type of educational delivery. So thank you.